Okay, good evening, everybody. Please, if you can see my screen and can hear me, please, can you just react? Okay, okay. So, good evening once again, everybody. Trust we are all doing great tonight. And first, sorry, excuse me, please. Um, our topic for tonight, just like we said it last week, that we are starting our group account calculation fully today. Okay. Someone said he can't hear me. She can't hear me. She's Rachel. Please, I think it's your network. Please, can you confirm? Everybody, can you confirm if you can hear me very well? Okay, yes. So I think it's your network. It's your network. So please, it's your network. Okay. Please, for now, if you have anything emergency to say, you can use the chat box. So we need to be very fast. So we need to finish this question tonight. So that by next week we move to sub. So that is it. So okay, I want to confirm if the YouTube, okay, the people on YouTube are now streaming now. I can see that people are joining us on YouTube. So that's fine. So I think I can start the class now. So this is May 2025. Question 1 is fairly subsidiary. Um, my day was fine. Thank you very much. My day was fine. Although it was stressful, but we thank God. As an accountant, we all know that it is not easy. So this is May 2015, sorry. I'm saying 2025. This is 2015 question 1. Sorry. Thank you for that correction. And um, this question is fellow subsidiary. Then I make sure, I think we need to solve this question because there's a topic, investment in associates. So when dealing with group account, then addition to investment in associates, so I think we need to look at that too. And that is the reason why I choose this question. I think we need to solve this question. So, however, by next week, we are moving to sub. We are not solving any fellow subsidiary again, but last diet, I solved one past question. I think it was 2020 or 2021, Duru PLC. So I will forward that link. In fact, I will add it to the link. The question has been solved, and I'll send the solution so that we will solve two past questions like that. You just rewatch it. Immediately after this one, you just rewatch that one. So make it two past questions of fellow subsidiary. Then doing revision by God's willing, if our revision can take place this diet, I can now solve one more past question. So remember I said it, for you to be fine in fellow subsidiary, foreign subsidiary, you need to solve at least 3 to 4 past questions. 3 to 4 past questions. And if you have time, maybe you have one paper to go, please solve 5 questions. So that is it. So now let's start the class. The time is going. So okay, Bariwa. This question is Bariwa has 2 subsidiaries. So, but the correction number 1 I want us to make is that for the people joining us outside Lagos and all over the country, please, if you want to solve any question in ICANN, please don't start from the top. Start from the bottom. Being it SFM, being it any course you are writing in ICANN, please go to the requirements. So when you go to the requirement will give you at least 20% insight about the question. So when you look at the requirement, so any question you want to solve, please go from the requirement first. So look at the requirements. Prepare a consolidated statement of financial position as at 31st May 2020, May 2013 for Bariwa Group. So that's the requirement. So with that, we have the idea that, okay, this is a consolidated statement of financial position that they ask us to prepare. Because there are sometimes they are not going to ask you to prepare consolidated. They are just going to tell you to do adjustment. So the first thing I want us to take note is requirement. So now let's go together. Let's quickly read the question together. Let's read the question together. So Bariwa, okay, someone said I should zoom it. So sorry, I'll zoom it. Even for the people on YouTube, I need to zoom it so that it will be very clear. I think this is fine now. This is fine now. This is fine now. So Bariwa has two subsidiary companies and one associate. Since the adoption of International Financial Reporting Standard IFRS by the company listed on the Nigeria Stock Exchange, Bariwa has been preparing its consolidated financial statement in accordance with provision of IFRS. The drafted statement of financial position of Bariwa and its subsidiary as at 31st March 2013 are as follows. So they gave us the assets of Bariwa, Megida, and Mindara. So all the assets, non-current assets, they give us plants, they give us investments. That means cost of investment in subsidiary. They give us associates. That means the cost of investment in associates, calamari. Then available for sale investment. So they give us current assets, also all figures assumed to be correct, and trade receivables, cash and cash equivalents, and the likes. Then moving to equity and liability, they give us the share capital, retained earnings, other component of equity. The non-current liability, we have deferred tax assets, long-term loans, then trade payables and current tax payables for the current liabilities. So now let's look at the additional information together. I said the following information is relevant for the preparation of group accounts. Number one, on June 1st, 2012, Bariwa acquired 80% of Megida. On the acquisition date, they gave us the retained earnings of Megida, which is 1.36 billion, and other component of equity. And please, that is the pre-acquisition profit. That means retained earnings as a DOA. As a DOA, that is the retained earnings as a DOA. So the retained earnings as a DOA, other component of equity as a DOA. So they said there had not been issue of shares by Megida since the date of acquisition. Now the consideration comprised of cash of 3 billion, whereas the fair value of identifiable net asset of Megida was 4 billion. Now they said the excess of the fair value is due to an increase in non-depreciable land. The independent valuer stated that the increase is in the independent valuer stated that the fair value of the NCI in Megida was 860 million on 1st June 2012. It is the policy of Bariwa to measure NCI at the basis of their proportionate net asset. This information is very, very key. It's very, very key. The group structure, the group policy, sorry, they will tell us maybe the NCI is valued at full goodwill or proportionate net asset method. So in Bariwa now, they told us that the group policy is to value NCI at proportionate net asset method. And if you remember very well, I said it that whenever it is proportionate net asset method, the goodwill belongs to the negative goodwill, which is an income, belongs to only parents. That's number one. The impairment in goodwill will be suffered by only parents. So that is the implication. So now let's move ahead. Let's move ahead. So as I said, it is the policy of Bariwa to measure NCI at proportionate share of identifiable net assets and not fair value method. You see, they told us expressly, and not fair value method. Now, also on 1st June 2012, Bariwa acquired 70% of Mindara. Then the consideration of the acquisition shares was 1.28. The purchase agreement on 1st June 2012. Bariwa is required to pay the former shareholder 30% of the profits of Mindara on 31st May 2014 for each of the financial year 31st May 2013 and 2014. So that information, they are telling us that according to the purchase agreement, there is additional money that Bariwa is going to pay. And that is what? That is contingent consideration. Remember, I told you that there are four ways a parent can acquire the subsidiary. Number one is cash payment. Number two is deferred consideration. Number three is contingent consideration. Number four is what? Share exchange. Then number five is liability assumed. So why that number five is not very, very common, but those are the four ways. So now this information, when we want to solve, I will explain why it is a contingent consideration, why it is not a deferred consideration. I said it last week, if you remember very well. So further information, I said the fair value of this arrangement was estimated to be 120 million as at 1st June 2012. The value has not been charged and not been included in the financial statement. The fair value of the identifiable net asset of Mindara is 1.76 billion. Then they give us the retained earnings, another component of at DOA. So, okay, respectively, they said no issue of share capital was issued as at date of acquisition. The fair value of the identifiable net asset is an increase as a result of PPE, while they give us the fair value of NCI at that in Mindara was 530 million. The PPE is depreciated on a straight line basis over 7 years. Okay, let's go. Now they gave us another information, additional information 3. Barrier acquired 10% in Calamari. So when a parent company acquires 10%, that is an ordinary investment. A public liability company for 80 million. The investment is accounted for as available for sale investment. Then, okay, on June 2012, Bariwa acquired additional shares of 15%. So, of 15%, then achieved significant influence. Calamari made a profit after dividend of 60 million and 100 million respectively. So finally, they told us that on June 2012, Bariwa purchased an equity instrument of 100 million peso, which was a fair value. So the instrument was classified for available for sale. Now the exchange rate is as follows. So Bariwa also did what? He also purchased another investment, which is peso. Peso is what? Peso is the currency of Mexico. So the Mexican currency is called peso. So he bought an investment again. So they now give us the fair value of the investment as at 2012, then 2013. So if you look at it, we need to check maybe there is an increase in fair value or decrease in fair value. So they said Bariwa has not recorded any changes in fair value. The reduction in fair value is deemed to be as a result of impairment. So they told us that again, that the reduction of the fair value is due to impairment. So then the last additional information, they said the director has included in the loan to director. The directors have included a loan to a director of Bariwa in cash and cash equivalent. The loan has no specific repayments, but it is repayable on demand. The director feels that there is no problem with the accounting entries. That means the choice of accounting policy within the IFRS, and that shows that the loan as cash is the choice of accounting policy. That the policy cannot be utilized. So additional information 6, there is no impairment of goodwill arising on consolidation. So these are the 6 additional information. So, and as I usually say it, out of the 6 additional information, by default, you have idea of 3. The remaining 3, they will test standard. So, and if you don't know additional information in the exam, please, you cannot kill yourself. Do the one you know and do your best. I'm very sure you will get at least, out of 30 marks, you get at least 15 marks, 18 marks, 20 marks, even though you attempt only 3 additional information. So not that I don't know this additional information, you now leave it. No, you try your best. So now we are going to solve this question now. So I've sent this question to your group. I need one person that will give me, that will just read the question, then we'll solve together. We are going to solve this question together. So let me stop sharing this screen now. Let me bring out my Excel. Let me share my Excel so that we can start solving this question. So please, can you see my Excel? Okay. So I think my screen is somehow, I have building my screen very well. So but let me build it little for the people on YouTube so that it will be at least bigger. I think it is fine like this. It is fine like this. It is fine like this. So please we can just bring out our phone. If you are not using, for people using you laptop, you can bring out your um phone to be looking at the question so that we are going to be together. So now, according to the requirement, so let's start now. Let's start, please. According to the requirement, they said we should do what? We should prepare the consolidated statement of financial position of who? Of Bariwa Group, Abi. So we can just come here. We can say Bariwa Group consolidated statement of financial position as at when? As at 31st May 2013. So this requirement that you are doing, this what we are doing here, you are already getting tick. That is the beauty of group account. That is the beauty of group account. You are already getting tick for this heading that you are putting, and that is the approach I want us to use. Immediately assuming this question, you are doing this question in the exam, just in your first 2 pages, just use it for your solution page. Then your third pages, you can use for your workings. You empty your balance sheet. We are going to empty our balance sheet together. Then we move to additional information. Even though you cannot finish that question, at least you get significant marks. And that is the approach majority of the people are using. I know there are so many people that attend different tutorials, you see this approach, but I can tell you for free that this approach is one of the best approach. In fact, it will increase your confidence in the exam. So we have deal with the heading. This is the requirement we have find. So if you remember very well that the consolidation rule, the procedure for consolidation is that the parent and the subsidiary asset must be matched together, right? The liability, the parent company asset liability must be added together. The only thing that are not going to match together is what? Is the equity. So if you go to the question now, plant. So can somebody okay, we don't need to waste our time. Let's do it like this. Let me just open the question here with me here. Please, let's do it like this. Now let's start emptying our balance sheet figure. So if you look at the question, they gave us all the figures. They gave us that plant. They said plant for the parent company is how much? They say plant for the parent company is 2,650. So that we are going to be fast. Plus, the rule says that the parent company asset and subsidiary asset must be matched together. So we are going to add parent companies, then plus the 2 subsidiary company. This is the plant. So the next item is what? After plant, please let's keep our eye on the question. After plant, the next question is investment, right? But the rule is that you must introduce goodwill. Please, our number 2 rule for tonight is that immediately after your PPE, please introduce your goodwill. Even though when you now solve the question, if the goodwill is now dash Assuming the goodwill is zero, please, you cannot kill yourself. In the example, you can put goodwill like this is zero. Examiner will not kill you. Examiner will not kill you. Do you know? If you put zero like this in the example, that means when you calculate goodwill, the goodwill is zero. Put it like this. Examiner will not do anything to you. So that is it. Introduce your goodwill. Then your goodwill will be what? Will be calculated from working note 3. Now, what's the next item? They said Megida Abi, investment in Megida. So what are we going to do? Let's use this approach again. For now, let's use this approach. Megida, investment in Megida is 3,000 naira plus investment in Mindara is 1,280, right? Both of them, leave it. Now, investment in associate calamari, Abi. Now, you are going to create another working note for investment in associate because in line with IAS 28, investment in associate. In associates, IAS 28 says that we should account for associates using equity method. So, and when we are using equity method, we are going to measure that investment in associate at cost. Then we are now going to recognize all the all other income, the profit that is received from associate. We are going to add it to it. So, and that is the equity method of IAS 28. So it is better to create your working note. You just call this one working note 7. Because if you remember, our working note 1 is group structure. Please, we did this, we talked about this last week. Our working note 1 is group structure, if you remember very well. Then working note 2 is what? Net asset of subsidiary. Working note 3 is determination of goodwill. Working note 4 is calculation of NCI. Working note 5 is consolidated retained earnings. Then here in this question we have OCE. Now our working note 7 will be that investment in associate. So you are going to create working notes for investment in associate because we have to account for it in line with IAS 28. Please, are we still together? Are we still together? Okay. Okay. So that is good. That's good. Please. Okay. Oh, someone wants to ask question. Please, can you put your question in the chat box? I will look at it. We have a long way to go. We have a long way to go. Oh, are you not seeing my screen? Can't you see my screen? I think my screen is big enough. My screen is big enough. So you can just use the chat box. We have a long way to go. A long way to go. So we don't have time. At least by 11, we must finish this class. There is work tomorrow. So drop your question. I will look at it. So available for sale investment. How much is available for sale investment? That is 510 for parent company, right? Plus subsidiary Megida 60 plus subsidiary Mindara 50. So we have dealt with all the assets section, right? We have done with it. Now, the best approach you are now going to do is that immediately you are done with each section, please leave 2 lines. For exam's sake, just leave 2 lines. There are some adjustments that will come out in the exam. In professional level, there are some adjustments. Those adjustments cannot be more than 3. Those adjustments cannot be more than 3. Someone say you can't see my screen. Mrs. Rachel again. I think your network is very bad though. I think it's your network. And I can't advise that you should log out. Because if you log out, I don't think you can join because the class is filled up already. So it's your network. Just calm down. You see my screen. It will come back. It's your network. So let's go ahead. Okay, I can see now. It's your network. So let's go ahead. So immediately after your non-current asset, please leave 2 lines. Leave 2 lines. That 2 lines is an adjustment line. There are some adjustments. There are some assets that can be watched that will be introduced in the exam. that will be recognized. So what when the examiner give you those information, you can now recognize it. And in the exam, if the examiner did not give you any adjustment, will you kill yourself? No. Will I can't beat you that you lose 2 lines? No. But for safe hands, just leave these 2 lines. After your non-current asset section, leave 2 lines. So now let's move ahead. After the non-current asset section, we move to current assets, right? Now on the current asset section, what's the first item we have? We have inventory. What's the inventory of parent company? 1,350 plus what's the parent of um Mindara? 550. Then Megida 730. I really wish one person can be giving me this figure. But if I unmute everybody now, some people will be disturbing us again. So let's just manage it like this. Now, after inventory, we move to trade receivable. For parent 910, for Mindara is 450, for Megida 450, then for Mindara is 320. Now, cash and cash equivalent, right? So 1,020 for parent, then for Megida 1,000, then for Mindara 80. So we are consolidating based on the principle of IFRS 10. It said we should merge all the assets of the subsidiary and the parent together. So we are merging them together. So immediately after your current asset again, how many lines are we going to leave? Please leave 2 lines. But in the exam, I will advise you, just like me, when I was writing, I can usually leave 3 lines because all the adjustment the examiner will give you cannot be more than 3 lines. Cannot be more than 3 lines. It can be 1 or 2. In fact, it's usually 2. It's usually 2. But there are some questions that will be like tick. So when you leave 3 lines, it is better. So I will advise you just leave 3 lines. In fact, your solution will be neat. But please, everybody, don't let us forget to don't start with question number 1. No. Don't start with question number 1. No. Start with section C part. Those are questions that you can tackle when you read very well. You can tackle them. Please start with those sections. Section C, section B. Then immediately you answer like 3 questions. You can now go back to question number 1. Or 1 or 2 questions. Go back to question number 1. So now let's move. Now, equity investment. Equity section. So the first item on the equity section is what? Is share capital, right? So for parent company is 5,200. So for professional level purpose, please bring that 5,200 here because they might be share exchange. You know, I made mention that whenever the parent want to acquire subsidiary, he can exchange shares. I think we are going to find a question to solve to explain that. So whenever there is share exchange, the additional shares that will be exchanged will be added to this ordinary share capital. So that is the reason why it is better for professional level. Just put 5,200 like that because there might be share exchange. Now, how much is for subsidiary Mindara? 2,200. It's not going to be shown here. It's going to be shown in your what? In your working note 2. So the first subsidiary we have is what? Is Mindara, right? So we can put Megida. We can put Megida here. Then we can put Mindara here. We can put Mindara here. So how much is the ordinary share capital of Megida? They said ordinary share capital of Megida is 2,200. So just put 2,200 here. And as our DOC2, please do 2,200 here. Because the examiner said what? Examiner said there was no issue of additional shares. So at both your DOE and DOC, DOE is date of acquisition, which is June 2012. Then DOC is the date of consolidation, which is 31st May 2013. That means 1 year after. So now, for you to get this thing very clearly, it's better you put this B minus A, because for you to determine your post acquisition, you need to deduct DOC from DOA. So just put B minus A. So your B minus A is what? I'm using, there is a Excel formula here. That's why it's giving me dash. Because there are sometimes you are going to get minus. You have minus here, you get minus here. So if you are not very careful, your post acquisition will be wrong. But if you use this B minus A, it will be correct, because you just press minus 50 minus 70. The calculator will give you the correct answer. So please, let's move ahead. Now, the share capital of Mindara is how much? 1,000. So 1,000 here, 1,000 here. Now let's move ahead. We don't have time. Moving to the next item, retained earnings. They said retained earnings of the parent company. Retained earnings of the parent company is coming to your working note 5. Retained earnings of the parent company is 2,400. We put it here. Then the subsidiary company. Let's pick the subsidiary company. Let's start from Megida. The retained earnings of Megida is how much? It's 1,500. Please, we are going to put it as DOC. Why? It's because as a balance sheet date, that is the retained earnings as balance sheet date. So somebody want to ask question. Please, can you use the chat box, please? Can you use the chat box? I will check it. I'm looking at chat box now. So retained earnings of Megida is 1,500. Please, we are going to put it as our DOC. Okay, my screen is not showing. My screen is not showing. Please, is that true? Please, everybody, let's react. My screen is showing. Is your network? Because I'm also seeing my screen. If I can't see my screen, I will see it here too. So it's your network. My screen is showing. Please just calm down. It will come back. Just calm down. Please. Let's continue. It's the network. So retained earnings of Mindara is how much? 800. Let's put it here as our DOC. Please, if my screen is not showing, just calm down. It will pick. Just calm down. Now, let's move to the last one. OCE. OCE of the parent company. OCE of the parent company is coming here. Working note 6. How much is it? 120. 120. Now, OCE of Megida is 40, while OCE of Mindara is 70. So we can just put 40 here. Megida 40. Then Mindara is 70. I think that's the only one that usually slows us up and down. The rest, I think we will be fine. Now we can move to long-term liability. So long-term liability, just like the rule. What is the rule? I said the parent and subsidiary liability must be combined, must be added together. So this one will be 1,200 plus 1,500 plus 800. So please, all your questions, even when we are doing good cash flow, this is how we are going to do it. There is an approach to make your work easy. In fact, you will get significant mark. It's not that you will now be fearing. The only thing that can be fearing in group account is additional information. It's additional information. And out of additional information, you will know at least 3 or 4, and you will get significant mark. It's not compulsory you get 100 in ICANN. When you get 50, you are okay. When they give you 55, 56, 60, it's okay. let them hold their mark. So that is it. So deferred tax liability is 250 for parent company plus 90 plus 30. So after non-current liability, let's remember, please leave two lines. Then we move to the current liability. We have 1,150 plus 300 plus 600. Then, can see, you are not seeing my screen again, Abby? Oh, my screen again, Abby? Is it my screen? Okay, long-term liability. Okay, okay. Let me check my long-term liability. So long-term liability, 1,200 plus 150. Thank you. 150 plus 50. Okay, plus 50. Thank you. So it has been corrected now. Then deferred tax liability, I think that one is correct. Now, trade payables, I think that is correct. Now, the last one is current tax liability. Current tax liability is how much? 600 plus 80 plus 240. So, and after non-current liability, okay, after the non-current liability, we have current liability. So after the current liability, we are done. And we will leave two lines. So immediately we did this. In fact, you are already want to be finishing your exam, because all we have next is additional information. All we have is additional information. Now you have empty your balance sheet, and please, the more you solve question, what we did now, it cannot take you more than 15 minutes. And that is why you should practice. All these things that we did now, parent plus subsidiary plus associate, one associate, two, add it together. All these things that we did now should not take you more than 15 minutes. You have empty your balance sheet. Immediately you post all these balance sheet figures, you can now move to additional information. So we'll be taking the additional information one by one. So now let's pick the additional information now. Are we together? Please, let's now move. Let's now focus now. Let's move to additional information now. Now, additional information one. What is the examiner to do? The examiner said on June 1, 2012, Barua acquired 80% of equity interest of Megida. On the date of acquisition, the retained earnings of Megida was 1.36 billion. Another component of equity was 40 billion. So they gave us information about the group structure. Please, in the exam, please don't let us forget to let's construct our group structure. Who is the parent company? The parent company is Barewa. The parent company is Barewa. So Barewa is the parent company, and they now said it acquired 80%. 80% of what? Of the equity of Megida Abi. So Megida will be here. Megida. So Megida. So 80% of Megida. So we are fine like this. That's what happened uh when the retained earnings and OC was 1.36 billion and 40 million respectively. So now we are in Megida Abi. There's something I want us to take note here. We are going to hang, if you look at the balance sheet, sorry I did not show you. The balance sheet, they ask us to hang million. Please don't let us forget. They ask us to hang million. So when we hang million, this one will be N in million. So when we hang million here, we hang million here, then we hang million here. So when we convert 1.36 billion, it will be 1,360,000. You know it is billion. So it will be 1,360,000 because we have hang our million. All our figures is in million. Please don't let us forget. In fact, I nearly forget. Let's change this. This is our solution page. The answer is in million and not billion, not thousand. It's in million. So all our figures is in million. So they give us the retained earnings. And please let's remember, remember I told you earlier that they will give us retained earnings as our DOE, as our date of acquisition in the additional information. So the additional information, they said retained earnings of an OC is 40, right? They give us this free of charge. They give us, that is our additional information one. When the retained earnings was 1.36 billion, then OCE was 40 million. So, and that is the reason why this one is 40. Remember that this one is a million. So this is 40 million. So, and this our B minus A. Remember, immediately I put my Excel formula here, we are already getting our post-acquisition profit. So let's continue. Let's continue. Please, are we together? Are we together? Please, let's continue. Let's continue. So now let's go. Let's go. Now, there had been no issue of shares by Megida since the date of acquisition. The consideration comprises of a cash of 3 billion. Now, let's pick it one after. They said the consideration to acquire subsidiary. They said the acquisition, the cost of acquisition is 3 billion. So the cost of acquisition in Megida will be 3,000. Remember, this one is a million. Let's change it immediately. This one is a million. So cost of acquisition will be 3,000. And let's continue, please. Whereas the fair value of identifiable net assets. Now, the fair value of identifiable net assets. In fair value of identifiable net assets, okay, there's an Excel formula there. Let's maintain the Excel formula. Sorry. Let's maintain the Excel formula. The fair value of identifiable net assets is how much? Is 4 billion. So it's already 4 billion. Okay, this one has Excel formula. Then this one has Excel formula. Okay, this one is 4 billion. 4 billion, which is 4,000. Now, our rule number 2 for tonight is that there are some time examiner will not give you this net assets. There are some time examiner will give you. If the examiner does not give us this 4,000, we will calculate all this, we will add them together. When we add them together, we get our sum, we get this figure. But here in this question, they said the fair value of the identifiable net assets of Megida is 4 billion, which is 4,000. Remember, we have hang million. Now, they now said the excess of fair value of the net asset is due to an increase in non-depreciable land. Now, there is something I want to show everybody. When you add up all these figures together, look at it. How much is it? Look at my Excel here. It's 3,600. Then examiner has given us 4 million. So there is an excess. So, and that is what I want everybody to take into. Whenever examiner give you this 4,000, this 4 billion, there must be a balancing figure here. There must be a balance. Whenever you are giving this, the chances of balancing figure is 90%. It's 90%. But in this question, there is a balancing figure. What is the balancing figure? When we added these three together, what did this give us? 3.6 billion, Abi? 3,600,000. So let's pick our formula. This 4,000 that the examiner gave us minus 3,600, which is the sum of the three. When we press it, it is 400. So 400 is the balancing figure. Now, the examiner told us, please let's go back to the question. The excess of this fair value is due to an increase in non-depreciable land. So this 400 is as a result of non-depreciable land. So you just put it here, non-depreciable land. Non-depreciable land. Examiner will tell you why there is an, so that non-depreciable land, you just put it balancing figure, because you are the one that will determine this balancing figure by yourself. Nobody will tell you. You are the one that will get it by yourself, because you, examiner have given you this. You add these three together. When you add these three together, you now minus it from 4,000, you get your balancing figure. So now the examiner have told us that increase, it was an increase in non-depreciable land. Increase in non-depreciable land. That is that 400. Now, I will now say another rule again. Please, let's take note. Now, this increase, you see this increase, whenever there is an increase in this net assets, you now look at this increase. Is it a depreciable asset or non-depreciable? So if it is a depreciable asset, we are going to calculate depreciation. We are going to calculate depreciation. But if it is not a depreciable asset, we will not calculate depreciation. So in this question now, in Megiddo now, they said it is non-depreciable land. So are we calculating depreciation or not? If you are calculating, let's use thumb up. If you are not calculating, let's use thumb down. Okay. So we are not, I'm seeing thumb down, no. I'm seeing thumb down, no. We are not calculating depreciation, no. Why? It is because land is not depreciable. So we are not calculating any depreciation. So whenever the increase is as a result of non-depreciable assets, which is non-depreciable land, we are not calculating depreciation. Hope we all get it now. So we are not calculating depreciation because this is non-depreciable asset. Land is not depreciable. So hope we get it like that. So now, this increase in non-depreciable assets, please don't forget, you must put it both in DOA and DOC. It must be in DOA and DOC. Why? Do you know the reason why? Let me quickly explain. Because it is the requirement of IFRS 3 business combination that for you to determine your goodwill, you remember that this figure will be used to calculate your goodwill. Your goodwill must be at fair value. So immediately the subsidiary is acquired, you must revalue the assets of the subsidiary as at date of acquisition. So this revaluation is as a result of IFRS 3 that you should revalue. So this non-depreciable land is as a result of fair value increase. So since this is as a date of acquisition, this will also be 400. Please, let's take note. So not that this one will now be in 400, this one will now be in dash. Both of them will be 400. But your depreciation, it's only your depreciation that will be in DOC. It's only your depreciation that will be in DOC. And whenever we get there, I will explain why it is going to DOC. Only, DOC only, not DOA and DOC. Because that depreciation must reduce your post-acquisition profits. So that's about that. Please, let's go ahead. We have a long way to go. Let's go ahead. Now, what does the examiner says again? Examiner says an independent valuer has stated that the fair value of NCI in Megiddo is 860 million on 1st June 2012. It is the policy of Bariwa to measure NCI at proportionate net asset method. It is the policy to measure NCI at what? At proportionate net asset method. Now, this is a big trap. Please, in fact, some people that understand group account, I'm very sure so many people will enter this gutter. It is a big trap. The examiner give you the fair value of NCI, but the examiner told you again that what? That the group policy is to what? Is to value NCI at net asset method. So whenever you want to do what? Whenever you want to value NCI, you look at the group policy. The examiner specifically told you that it is what? It should be at proportionate net asset method. So that is 60 million that examiner give us is a trap. Please, let's take note. That 860 is a big trap because this NCI, that 860, we don't need it to. How are we going to get our NCI? We are going to, they said it is proportionate net asset method. What is the NCI percentage in this question? Megida, parent company is 80%. Megida will be 20%, right? So to calculate your NCI, just do 20% multiplied by the net assets. So how much is the net asset? They gave us 4,000. So 20% of 4,000, that is 800. So NCI value as a DOE is 800 and not 860. So that 860 that examiner gave us is a big trap. It is a big trap. That if you are not very careful, so many people will go and carry it. You just go and use it as your NCI value as a DOA. So that is it. NCI value as a DOA, I will come again one more time, should be based on the, if you remember the note I gave you last week, I said NCI value as DOA should be based on the group policy. The examiner told us here that the group policy is to measure NCI at net asset method, proportional net asset method. The examiner told us when I read the question the other time. Now the examiner now give you again full goodwill. They said NCI fair value is 860 million. So I'm now saying that is a trap. Assuming the group policy is that we should value NCI as a full goodwill, you just pick that 860, just put it here, 860, because it's like a bonus. You just put it here. But in this question, NCI is not valued at full goodwill. It is valued at proportionate net asset method. So how are you going to calculate it? You just pick NCI percentage, 20%. 20% of what? 20% of your net asset. And the net asset has been given. Remember, this is Megida. Net asset has been given. This is our net asset, 4,000. So for you to get your NCI value as a DOA, you just calculate NCI percentage, 20%. Remember, parent is 80%. So 20% times 4,000, you get your 800. So that's the NCI value at DOA and not 860. So that 860 is number one trap in this question that so many people will enter. And immediately you get this 800, please come and paste it here. It's copy and paste. You use it here too. So when you want to get your NCI value at DOA, you use it in two places. You use it in calculation of goodwill. You add it to the cost of acquisition. Then you do what again? You take it to your calculation of NCI. That means you debit cost of investment, then you credit NCI. That is the accounting entries. But here you take one. That figure, just copy and paste. Just paste it there. So that is noted like that. Let's continue. Our time is going. So now, what the examiner give us again? They said it is a policy to measure NCI on base of their proportionate share interest in the identifiable net asset. We already read that. of the acquired subsidiary and not fair value, that means full goodwill method. That was just I just explained now that the good policy is to measure NCI as at net asset method, proportionate net asset method. So we need to calculate our NCI. Whenever the fair value, the good policy is at proportionate net asset method, you calculate your NCI. But whenever it is at full goodwill, it might be given and it might not be given. So whenever it is at full goodwill, thank God we will solve foreign subsidiary, we will solve fellow subsidiary, we will solve piecemeal, we solve so many questions. We will use full goodwill. So for the people that have forgotten how to calculate full goodwill, we will remember, don't worry. So now let's continue. So that's the end of additional information 1. Now let's move to additional information 2. So additional information 2, also on June 1st, 2012. So let's throw up on June 1st, 2012. What they said, Barewa acquired 70%. So 70%, so this is 80%. Now they acquire 70% of who? Of Mindara. So let's put Mindara here. 70% of Mindara. As at when? As at 1st June, the same date. The consideration of these shares was 1.28 billion. 1.28 billion. So the consideration, what is that? The cost of acquisition. The cost of acquisition is what? 1.28. That means 1,280. The cost of acquisition in Mindara is 1,280. Under the purchase agreement on 1st June 2012, Barewa is required to pay former shareholders 30% of the profit of Mindara on 31st May 2014, that is next 2 years, for each of the financial year 31st May 2013 and 31st May 2014. They now said the fair value of this agreement is what? Is 120 million. So that information that you are just giving now is what they call contingent consideration. Contingent consideration. Whenever the parent company wants to acquire a subsidiary, there are form of consideration. We have deferred consideration. Deferred consideration is very, very straightforward. I will pay the subsidiary, the shareholders of subsidiary company next year. When? I will pay you next year. I will pay you next 2 years. That is deferred consideration. There's an agreement. But contingent consideration, I'm going to pay you as a result of one thing or the other. Look at this now. They are saying 30% of the profit. Who told the parent company? Who says that the subsidiary is going to make profit? What if it earns loss? Any profit is not sure now. Everybody knows. When you say a company will make profit, when it is today, the financial year end has not ended, you are saying it will make profit and you will pay 30%. Is that realistic? You are not God now. What if COVID-19 come now? Yes, the payment is based on condition. So once there is no profit, it cannot pay. And that is why they call it contingent consideration. And contingent consideration, for the purpose of consolidation, we are going to use it. How are we going to? How much is it? 120 million, right? This is what we are going to do. We are going to debit the cost of investment. We are going to recognize it. How are we going to do it? Let's create another line here. We call it contingent consideration. Contingent consideration. Contingent consideration. How much is it? 120 million. 120. We are going to recognize it. The standard say we should recognize it. Now, You debit cost of investment for goodwill calculation, then you credit liability. You recognize that liability because it's a form of what? It's a form of consideration. So now, let's now look at it. The standard now says it's going to pay when? It's going to pay as at 2012 or 2013, but it's at that consolidation. So one of the reasons why I usually that you should leave two lines, those two lines that I said that we should be leaving, it will now come into effect now. It will now come into effect. When are they going to pay? That 120 million, when are they going to pay? Let's look at the question together again. If that payment is going to be made for more than 1 year, it's going to non-current liability. But if it is only 1 year, it is going to current liability. Remember, in line with IAS 1, any liability you are going to settle within 1 year should be current liability. But any liability that you settle more than 1 year should go to non-current liability. That's requirement of IAS 1, which is now FRS 18 now. So now let's look at the question together. Are we putting it in non-current liability or current liability? Now let's look at it. Okay. Bariwa is required to pay former shareholders 30% on 31st May 2014 for each of the financial year to 31st May 2013 and 2014. So I said it's going to pay in 2014. That's what? After 2 years for each of 2013 and 2014. So it's going to pay 30% in 2013. Then it's going to pay in 2014. So when are we consolidating? We are consolidating in 2013, Abi. So we can, since it's going to pay for each year, please let's look at the English, for each year. So he will pay in 2013 and he will pay in 2014. So since he's going to pay in 2013, so from June 1st, 2012 to 2013 is 1 year. So we can put it in current liability. So we are just going to put it here, contingent. So in 2014, when we are consolidating for 2014 too, we will put it there again. But here, 2014 is not our concern. So it's not our concern. Our date is 2013, so we can just put it here. So contingent consideration, assuming it's not for each year, we are going to take it to non-current liability. How much is it? 120. So for your revision purpose, when you are reading, let me put it here. Additional information. Is it not additional information 2? So in case when you are solving on your own and you are now finding 120, where did they see this 120? Because I remember so many people that are very busy. People like me that are very busy. Before they carry this fellow subsidiary again, it might be next 2 months. You now be saying, where did they see this 120? They'll now be messaging Mr. Taufik. And me, I will not answer you then. Me too, I have exam. So just let's put it like that. So in your additional information too, you find your 120. So now let's go. Our time is going. The fair value of this arrangement was 120 million. We are done with that. The value has not changed and has not been included in the financial statement. So there are some times this contingent consideration is going to change. They will tell you that there is an increase. So whenever there is an increase, that increase will now go to your retained earnings. We are going to see a question that we are going to, don't worry. That changes in contingent consideration will reflect in your retained earnings. When it is an increase in liability is an expenses. So we are going to add it to our retained earnings. But when it is a decrease, we are going to less it from our retained earnings. But don't worry about that. We will find another question that will give us increase in contingent liability. There are sometimes there will be an increase and a decrease. So, but in this question, you see the examiner say the value has not changed. They told us that it does not change and it has not been included. So when there is an increase, it will affect your retained earnings. When there is a decrease, it will affect your retained earnings. But let's leave that. There are so many questions we are going to see. Now, the fair value of the identifiable net asset is 1,000,000, 1.76 billion. So let's quickly deal with that. Let's deal with that. So where is that one going? Net asset of Mindara. Now, have we deal with, okay, maybe we are in Mindara, right? Okay, yes, we are still on point. The fair value of identifiable net asset is okay, it's already here. Maybe 1.76 billion is here. Okay, this is here. 1.76 billion. That is the net asset of Mindara, the fair value. And the retained earnings and OC, we are what? 550 and is it 550? Yes, 550 retained earnings as a DOA. Then other component of equity is how much? Is, I can't see this question. 70. Okay. So other component of equity is 70. So we are done with that. So what did they say? Okay, they said there had been no issue of share capital by Mindara since the date of acquisition. Can we see now? And that is the reason why this DOA and DOC are usually the same. Some people will just ask me, why is this ordinary share capital? Why is it always the same? Because examiner have already told you, and so many questions, in majority of the questions, there have been no issue of shares by the subsidiary. So this will be, both of them will be the same at majority of the time. So let's move ahead. Okay, there have been no issue of share by Mindara. Then the excess of fair value was due to an increase in PPE. So there's an increase in PPE. The fair value of NCI was 530. Are we going to use it? Let me ask that question again. The fair value of NCI in Mindara is 530. Is it relevant to us? Are we going to use that 530? No, we are not going to. It's a trap again. No. That fair value, we are not going to use it because the group policy is to what? Is to value NCI as at proportionate net asset method. So we are not using it. So that 530 is also a trap. So let's take note of it. So now let's quickly deal with this issue, this Mindara issue. So they said there is a what? There is an excess. Let's check, maybe there is an excess. If you add these three together, how much is it? 1,620, right? So 1,620. So 1,620. Now let's take it now. Is equal to this net asset minus 1,620. Egole, how much is it going to give us? It's going to give us 140. And they told us, what did the examiner said? The examiner said that the fair value is as a result of increase in PPE. Abi? So increase in PPE, right? Which is plant PPE, which is what? Balancing figure, right? Balancing figure. Balancing figure. So the examiner now said what? The examiner said, where is it? This thing again. I cannot see you. Okay. The PP is depreciated on a straight line basis. The PP is depreciated on a straight line basis. So since PP is depreciated on a straight line basis, there will be what? There will be depreciation. So we need to do what? We need to calculate depreciation. we need to calculate depreciation. Now, depreciation, this increase, please don't forget, it will be in DOC and DOA. Please don't let us forget though, both DOC and DOA. But our depreciation, so there is a depreciation. Depreciation will affect only DOC only. Depreciation on increase in PPE. So that increase, there will be a depreciation on it, and that depreciation is coming here. It is affecting only your DOC. It will not affect your DOA. Please, let's take note. And that is the reason why this one will be balanced. Remember, this one is balancing figure. Can you see that it's 1,760 and our net asset is 1,760? So this one will be balanced. Our depreciation will affect DOC only because that depreciation must reduce our retained profit. It must reduce our retained profit. So now, before we deal with that, do we have any other information? Let's check if you have any other information. Let's deal with that additional information. Then let's calculate our depreciation. They said, okay, the fair value of NCI is 530, and we have agreed that we will not use it, Abi. Maybe we have agreed that we will not use it. So let's calculate our fair value of NCI, 30%, right? Parent company's control is 70%. So NCI will be 30%. So 30% of what? 30% of net assets. What is the net asset? 1,760. 1,760. So 30% of 1,760. Let's use Excel here. 0.3 multiplied by 1,760. So NCI value as our DOA is how much? Is 528. So our NCI value as our DOA is 528. And please don't forget, immediately you get it, just copy it and paste it here because you use it for your calculation of NCI. Just copy and paste it here. It is the same thing. So all we need in that additional information, I think we are fine. The only thing that is left in that additional information is calculation of depreciation. And that's where we now go to these workings. So working note 1 is calculation of depreciation. Calculation of depreciation. Depreciation on PPE. Let me just short it like that. And what is the formula? Let me put it down because when you are working on your own now. So that fair value increase. Let's use fair value increase. So this is the formula. Fair value increase divided by number of useful life. Number of useful life of the assets. Useful life of the assets times multiplied by number of years. Excel barrier. Number of years from DOA to DOC. This is a common formula for calculating depreciation. Although there are sometimes examiner will give you depreciation rates. Examiner will give you a depreciation rate. So when examiner give you depreciation rate, the formula will change. Don't worry. When we see another question, you will see it. So what is our fair value increase in this question? Our fair value increase in this question, Egole, how much is it? I think it's 140 now, Abi. 140. This one, please let's check. Look at my note. This 140, this is the fair value increase. This is the fair value increase. 140. Abi, 140 divided by what is the number of useful life? Number of remaining useful life, sorry. Number of remaining useful life. Remaining useful life. They gave us in the question. They will give you all those information in the question. Number of remaining useful life. They said it's 7 years. So they said 140 divided by 7 years. They gave us 7 years. Multiplied by number of years from DOA to DOC. So number of years from DOA to DOE is just 1 year. It's just 1 year. And our answer will be what? Our depreciation will be how much? 20 million. That means 140 divided by 7. It will be 20 million. So that depreciation, our depreciation is how much? 20 million. That is our answer. So then we will take it here. Abi, this is 20 million. Depreciation will reduce your increase. Just put it here. So can you see that immediately I put 20 million here? This formula will help us. It will take care of it. And that is where it is good to be using this B minus A. So that depreciation, just take it here. Then press your calculator. B minus 20 minus is 0 because there's nothing here. There's nothing here. Just get your 20. And that will make your post-acquisition to be minus 20. Then your post-acquisition profit will be 230. This depreciation must affect your post-acquisition. So that is that about that. So I think with that, we can calculate our goodwill. Abi? Yes, we can calculate our goodwill. So when we calculate our goodwill, exactly, is equal to sum. Let's calculate our goodwill. So our purchase consideration in Megida is 3.8, while in Mindara is 1.1928. So, and what is our net asset? They give us net asset 4,000 a year. Abi, our net asset in the question, they already give us, which is what I highlighted. Look at it. This is our net asset to 4,000 and 1,760. 1,760. So we can determine our goodwill now. We can determine our goodwill. So our goodwill. So is there a goodwill in Megida? No, because purchase consideration is lower than the net assets. So there is no goodwill. This is negative goodwill. This minus this is 200. And negative goodwill is what? Is an income. Negative goodwill is an income. So we can copy this formula, then we can paste it here. It is 168. So this goodwill, negative goodwill is an income. So let me remove this formula so it will not cause for allow. So this 168 is the goodwill that will be recognized in the statement of financial position. It is a positive goodwill. But negative goodwill is an income. It will be what? It will be taken to the retained earnings of the parent company. Why? Let's take it here. Negative goodwill. Let's do that immediately. Negative goodwill is an income. And please remember, it's 200 though. That negative goodwill is just telling us it's an income. Please don't put minus 200 though. It's an income. Negative goodwill. It belongs to only parent company. Why? Because the NCI, the group policy is to value NCI at proportionate net asset method. So whenever the group policy is proportionate net asset method, the negative goodwill belong to only parent company. Only parent company. And the impairment loss will be suffered by only parent company. So in this question, the negative goodwill is going to retain earnings of the parent company. Now let's quickly deal with that positive goodwill. That positive goodwill will be what? Will be recognized as an asset in the statement of financial position. So let's quickly deal with that. So we can do what we can link it. We can link it. Can link that now. So we can recognize our goodwill, which is a positive goodwill. So assuming in this question, this one too is positive goodwill of 200. We will now add 200 plus 168. We now put 368 here. So this 368 will now be recognized as an asset. But one is negative, one is positive. That's why you are not adding it together. So you recognize one as an asset, you recognize one as an income. Hope that is noted, please. One is an income, one is an asset. You recognize this one in SOFP, you recognize the second one in the retained earnings. So that's about that. So we have calculated our goodwill, we are done with that. Please, I also think let's quickly do this. Let's recognize our post-acquisition profit once one after one. Do we have anything again? So I think let's recognize our post-acquisition profits. I suggest. So in Megida, let's quickly deal with that so that we just know that the rest is another thing. Now, the post-acquisition profit in Megida is how much? Is 140, right? Is 140. Parent company will collect 80%, while the NCI will collect 20%. So now let's go to NCI first. So this is Megida, Abi. This is Megida. This is NCI, 20%, Abi. 20% multiplied by 140. 20% multiplied by 140. So we can copy this and take it to calculation of retained earnings. So this is Megida. So but this one will not be 20%. This one will be 80%. Abi. This will be 80%. So 80% of 140, who can give me that figure? Or let me get my figure by myself. Don't worry. 0.2 multiplied by 140. So this is 28. Why? Let me quickly get this one too. This one will be 0.8 multiplied by 140. So we have dealt with this now. We have dealt with this. Let's quickly deal with Mindara. Let's deal with Mindara immediately. What is the post-acquisition profit of Mindara? 230, right? 250 minus 20. That's 230. So let's quickly deal with that one. So now, let's go to NCI first. Let's copy this and paste it here. So this is Mindara, right? Mindara. Then how much is the profit? 230. What is the percentage in Mindara? It's 30%. So is equal to 0.3 multiplied by 230. This one is 69. So there's an Excel formula here. So this is total NCI. So now let's copy this too. Let's copy it and paste it for retained earnings of parent company. So this will be how much? The control is 70%, right? So this will be 0.7 multiplied by 230. Then we get the parent company's share of post acquisition. Abi? So that is fine like that. That is fine. I think we are good like that. So what are we left with? We are not left with anything again. Eh, it's good like that. Now let's proceed to additional information 3 and 4. I said 3 and 4. Yes, we have additional information 3, 4, and 5. That 5 is a short one. So I think we can quickly finish up. So that we can finish up. This is already past 10 already. So now let's move. Let's move. Are we still together? Yes. Let's move together. Let's move. Let's move. Now, additional information 3. Bariwa acquired 10% interest in Calamari, right? A public liability company on 1st June 2011. Can we see now? Before consolidation. Consolidation date is what? Consolidation date is 1st June 2012. So Bariwa has invested in Calamari before consolidation. So now let's go. So let's name this heading. Sorry, excuse me, please. Investments in Calamari. Am I correct like this? Is it Calamari? Oh, this is not Mary. Hope Auntie Mary is not on this call. If she catch me, I'm writing Calamari. If she catch me, okay. This is Calamari. Okay, we are correct now. Now, they said Bariwa acquired 10% in Calamari on 1st June 2011, before 1 year before consolidation, for 80 million. The investment was accounted for as available for sale investment as at 31st May 2012. As at 31st May, the value is now 90 million. Can you see? The value of the cost of that investment is 80, but 1 year after, it has increased to 90. There's the fair value increase. So on June 1st, 2012, Bahrain acquired additional 15% for 110 million and achieved significant influence. What is significant influence? That means you are now an associate. That means when you have an investment of more than 20%, but less than 50%, so you are now an associate. So Bariwa is now an associate with that additional 15%. Calamari made a profit after dividend of 60 and 100 million for the year 2012 and 2013. So 1 year is relevant to us, which is that 2013. 1 year is not relevant. Please, let's take note. Now, this is investment in associates. And I said it earlier that whenever we have an associate, the standard says, IAS 28 says that we should account for that investment in associate in line with using the equity method. Now, there is one issue in this question, and I need to quickly address it. We don't know what can do. They can repeat question. We don't know. We can be lucky at Apex. They can repeat question, and we will just clear it. Now, before the normal standard that talks about investment is what? Is IFRS 9, right? IFRS 9 talks about financial instruments. Now, there was a standard before they change it to IFRS 9. There is a standard before, IAS 39. IAS 39 is what? It's classification and measurement of financial instruments. Before, we have IAS 32. IAS 32 is presentation of financial instruments. Why IAS 39 is what? Is classification and measurement of financial instruments. So, however, in 2018, yes, 2018, there was a new standard, IFRS 9, that now talks about financial instruments. And if you remember very well that in IAS 8 changes in accounting estimates and error. So, there are there is mandatory change and voluntary change. A mandatory change is a change that every company must do what? Must adopt, because it is mandatory. And the example of that is this standard. Whenever there is a new standard, you are going to neglect that old standard, then you move to new standard. So IS 29, IS 2039 is not in vogue now. The main standard now is IFRS 9. So why am I saying all this? If you look at this question, they said the investment was accounted for as available for sale. So sincerely, when I saw this question, so I said, which one is available for sale again? So when I now researched about it, I now saw it that it was the requirement of IAS 39. So if you remember very well, when you want to measure financial assets, on day one, at initial recognition, we measure it at fair value, right? We measure it at fair value. But on subsequent measurement, it depends. It depends on what? It depends on the motive of holding that financial asset. If we hold it for trading, we classify as fair value through profit or loss, right? Then, if you classify as owed to collect, that means owed to maturity, we classify as amortized costs, right? Then, if it is both, you classify as it is for trading, but when there is a favorable opportunity, you can sell. That is fair value through OCI. So, formally, in line with IAS 39, that fair value through OCI is regarded as fair value as available for sale. It was IFRS 9 that changed it to fair value through OCI. So when you have a financial asset for investment purpose, it is called available for sale. It is called available for sale. And the reason why I'm explaining this, when we start solving this, people will just be looking, which one is this? Which one is this? It is the requirement of IAS 39. In fact, I downloaded a note, an article on that IFRS 39. I will share it when we use. So I look through, it's like 3 to 4 pages. You can read it. You know, when they are using IFRS 39, we have not started writing like then. But for my screen is not showing. My screen is showing. No, it's not moving. Yes, it's not moving. Yes, it's not moving. I'm trying to explain this additional information to you before we start solving, so that it will not cause jow. Because when I start solving now, people will say, what is this? So now let's go. Since I have explained what available for sale is, available for sale investment is an investment held for investment purpose. And whenever there is changes in fair value, IAS 39 says that changes in fair value should be taken to OCI, just like fair value through OCI. So now let's now solve this additional information 3. So we have talked about it, that whenever investment is at available for sale, it should be what it is held for investment purpose, and fair value changes should go to OCI. However, there is a clause there that entity can retranslate from OCI to P or L. That means you can take that fair value changes from OCI to retained earnings. And that is what we are going to do here. So now, let's quickly solve it now. Now, they said Bariwa acquired 10%, right? For 80 million. That is the cost of the investment. However, 1 year later, it has increased to 90 million, Abi. So this is how we are going to treat it. So that additional information, okay, is there additional information 6? No, not additional information 6. It's additional information. It's working note 2. People can see my screen now. So this is how we are going to do it. Let's hang our million. This our million. So first investment, which is 10%, right? So that 10% is how much? Is 80 million. That was as at 2011. But as at date of acquisition, it has increased to 90 million, right? So we are going to put 90 million here. It was 80 million before acquisition, but as at acquisition date, it has increased to 90 million. So it is now 90 million we recognize. Now, the second investment is how much? It's 15%, right? So the second investment is 15%. So 15%, how much is it? That one is straightforward. They said it is 110 million. So when we add both of them together, or equal to, it will give us 200 million. So that 200 million is the total cost of the associate, total cost of investment in associate, total cost of investment in associate. Remember, after this 15%, we have become associates and we have achieved significant influence. So, which is how much? 200 million. Now, I said it earlier that whenever we are accounting from associate, we should use what? Equity method of IAS 28. An equity method of IAS 28 says that you should measure that investment in associate at cost. Then you now take into consideration additional benefits or loss that will arise from that investment. So as a result of this investment, they told us what? They said the associate made a profit. Now let's go back to the question. They said the associate made a profit of how much? It made a profit of 2 years. And I said we should take note. Please, let's take note that 1 year is not relevant. It is the second year that is relevant. I said Calamari made a profit after dividend of 60 million and 100 million. For what? For 31st May 2012 and 31st May 2013. So which one is relevant for is 31st May 2013. So since we have investment in associates, are we not entitled to profit? Yes, we are entitled to profit. So how much profit are we entitled to? We are entitled to 25% profit. We are entitled to 25% profit. So IAS 28 says that you should add that profit from associates. IAS 28 says you should add that profit to your cost. That is what they call equity method. So instead of recognizing that profit as something, no, you should add it to your cost. If it is a loss, you reduce it from the cost, and that is equity method. So profit from associates, how many percent? It is your percentage you take, 25% of what? Of 100 million. Remember, the profit made in 2013 was 100 million. So how much is it? It will be 25 million. It will be 25 million. So since it is 25 million, it is 25 million, then we are going to add the profit to it. So the total investment in associates will be what? The total investment in associates will be 225, and it must be shown in the statement of financial position. So total investment in associates. So total investment in associates. Total cost of investment in associates is 225 million. And we are taking it to SOFP. IAS 28 says that you should recognize it in the statement of financial position. And the reason why I'm solving this question is that because I can contest associate and fellow subsidiary so that we can know how to account for it. So this is the total cost of investment in associate. So, and let's quickly link it. This is it, our working note 7. Do we call it working note 7? So is it not working notes? Relevant working note 2. Relevant working note 2. So let's pick it like that, 225. So this is it, 225. Now we need to show some journal entries because this profit from associates, for every debit entry, there must be a corresponding credit entry. Please, hope we remember, for every debit entry, there must be a corresponding credit entry. So this 25 million, there is a journal entry for it. But before that journal entry, we have to prepare one more journal. The first journal is that journal entries. The first journal we first of all prepare is what? That 10 million increase. You remember this investment was 80 million, but it increased to 90 million. So that 10 million, we need to debit one thing, we need to credit one thing. We have debited investment in associate here. So we need to credit something. Remember, this has increased to 90 from 80. So that means we have debit investment in associate, but we need to credit something. So the first journal we are going to prepare is we are debiting, and we have already done that, investment in associates, because investment in associate has increased from 80 to 90. So we have debited it. Investment in associates. We debited investment in associate. How much? Equally 10 million. Why is this one giving us 10%? Who asks you should give us 10%? Number. Why is this one giving us? General. Look at this. And we don't have time. We don't have time. We don't have time. So then we will credit what? We debit investment in associate. Then we will credit in line with IS 28. No, not IS 28, IS 39. That whenever we are accounting for available for sale investment, that we should credit OCI, other comprehensive income. So we should credit OCI, other comprehensive income. So we credit other comprehensive income. How much? 10 million. And that was what we did. So we debit this 10 million. We use it to increase this to 90 million. Then this 10 million is going to your OCI. So let's quickly deal with it. It's going to other comprehensive income, which is other component of equity. So what are we going to call it? Increase in 10% investment. 10% investment. Increase in 10% investment. How much? 10 million. First and foremost, increase. We add it to it. Now, we are now going to prepare another journal. The second journal is that at the end of the accounting year, which is at the end of the year, the standard analysis, we can reclassify this 10 million. We can reclassify it to retained earnings. So what are we going to do? So let's copy this. And that is the reason why I was explaining the other time that so that I will not be doing magic now. We will now debit OCI. We want to reclassify that 10 million from OCI to retained earnings, other comprehensive income. Originally, on day one, they said we should credit OCI, but we can reclassify to retained earnings. So that's what we want to do now. So we now credit retained earnings. Retained earnings of who? Of the parent company. So we debit OCI. We have credited before, then we credit retained earnings. And that is what will now happen to us here. We will now minus this. This will be minus. This is minus. This one giving us. This. So this is 110. So we debit this OCI now. Then we now go and credit retained earnings. To credit retained earnings. So when we credit retained earnings, maybe we are going to increase. Remember, we increase equity. We credit OCI. We credit retained earnings. So we now attend to this. So that is the grammar I was speaking. And that is the reason why I quickly explain it before I now move to it. So the last journal entry we now prepare is what? Is this 25. I said this 25, this profit from associates, we are going to debit in fact, we have already debit investment in associates by 25. It has increased it from 200 to 225. So we have debit investment in associates. We have debit investment in associates. By how much? By 25, which have increased it from 200 to 225. Now, where are we going to credit? We are going to credit our profit or loss account. This is our retained earnings. We credit our retained earnings. We credit our retained earnings. By how much? 25. So that investment in associate, for every debit entry, there must be a credit entry. Because this retained earnings, we must take this 25 to our retained earnings. This is it. We take this 25 here. But if I do not show that journal entry, it will be like magic. So what are we going to call it? Profits from associates. Profit from associates. 25 million. So I think that's all. So what else again? So we are done with this. Let me see my people. My people have slept. Some people have tapa. And thank God this is recorded. You can just come back to the record. You will get it. Or you can send me my hand. So we are done with working note 4. That investment in associate. And this is how you are going to be doing investment in associate. And whenever I can test fellow subsidiary, they usually test investment in associates. So you can just fast forward this recording when I send it. Just listen to my explanation. It is not something that is hard. We are debiting one place, crediting one place. If profit from associate, we debit investment in associate, we credit our retained earnings. That's available for sale. We debit this first, then we now reclassify later. So now let's deal with the fourth additional information. They said, finally, on June 1, Bariwa purchased equity investment of 100 million peso. So the investment is classified as available for sale. So they now give us the fair value as at 2012 and 2013. If you look at it, there is a decrease in fair value, right? And they said it's as a result of impairment. So now let's quickly deal with that one. That one cannot take us for long at all. So purchase of equity investment, let's quickly deal with that one. Um, okay, let's quickly deal with that one. So that's our additional information for um, purchase of equity investment from Mexico, because that investment, that peso is Mexican currency. So we have two data B. We have May 31st, 2012 and 2013. 2012 and 2013. Now, they gave us the fair value, Abi. They gave us the exchange rate. Now, IS 21. Are we going to divide or minus? Are we going to divide or multiply? Let's see, maybe we remember IS 21 that we did last week. 5.1. Why is this one giving us problem like this? 5.1. Then this is 5.0. So the investment was 100 million. 100 million. But it now reduced to 90. The fair value now reduced to 90 million. So this is the fair value. Fair value. So we need to determine. So are we multiplying or dividing? You know, this is IAS 21 now. For we to determine the amount in naira, are we dividing or multiplying? So now let's go back to the question. We are multiplying, Abi, direct quote. So people can still remember very well. They said naira to peso. Naira to peso. So naira to peso. That means naira to 1 peso. So, and whenever foreign currency is in 1 unit, whenever foreign currency is in 1 unit, we are going to what? We are going to multiply. So, whenever foreign currency is in 1 unit, we are going to multiply. If you remember our IAS 21 that we did last week. So, what are we going to do? 5.1 multiplied by 100 million. 100, 123, 123. So this will give us 510 million. Then let's copy this formula for this. But we'll change this one to 90 million. So this is 0. This is 0. Okay, we remove 1 0. So shall we correct? 5.1. Okay. This one is 5 million now. So is this 90 million? Is this 90 million? I think we are correct, right? Are we correct? This should give us 450 million. Okay, we need to change this. Sorry. This is for 5.0. So what's the difference? So there's a fair value decrease. This minus this. See? CLC wàhálà dé. E is E29. E29. So it's 60 million. So the fair value as at 2012 is 510 million. They now reduce to 450. So this is, the examiner told us that it is as a result of impairment. Please let's go back and read it. They said the director Bariwa has not recorded any changes in fair value. The reduction as at 31st May is deemed to be as a result of impairment. So it is as a result of impairment. So this 60 million is what is impairment. Is impairment. And what is the accounting entries for impairment? It must affect two things. It will affect our retained earnings, right? Please, let's don't forget. And that is the reason I don't want us to be talking about journal entries now. But let me quickly show it. Let me quickly show it. So the journal entry for that impairment, look at the journal entry here. So we are going to debit our retained earnings. It is going to reduce our retained earnings. To reduce our retained earnings, then it will also reduce our investments. That investment, to reduce the fair value of that investment, will credit available for sale investment, available for sale investment. So that is the journal entry. So we debit retained earnings with 60 million, then we credit available for sale 60 million. So, and what are we doing? We go back to our retained earnings. Where is our retained earnings? We will less impairment. Impairment of investment in Mexico. Let's just read it like that. So, impairment of investment in Mexico, which is 60 million. Abi, it will reduce that. We have debited our retained earnings like this. Then we are crediting this one. If you credit this one, will be minus 60. And that is why I showed the journal entry. So, someone not want to ask question. Let me go. Can you type it in the screenshot, please? Okay, it's fine, Abi. It's fine. We are fine, Abi. So, sir, is this equity instrument also financial instrument? Yes, it is also financial instrument. So, financial instrument is financial asset or financial liability. If you remember when we did IFRS 9, okay, we are going to do revision on IFRS 9. I will take you IFRS 9 revision. You have already done it, Mr. Mikinu Sulaiman have taught you. So financial instrument is either a financial asset or financial liability or equity instrument. So financial asset cannot be impaired. It can be impaired though. Okay, I can level. Financial assets can be impaired though. That is why IFRS 9 is long. If it is ACCA now, you can't escape financial instruments. Financial instrument is long thing, very, very long. You have no year of ECL, expected credit loss. This is a method of impairment. They call it ECL, expected credit loss, impairment of financial assets. So there is an impairment too, but in ICANN will just stop But in ACCA, IFRS 9 is long ago. We're talking about hedging, talking about derivative. IFRS 9 is long, but in ICANN, they will just stop and it is fine like that. In ACCA, we'll cover all the syllabus. So now let's deal with the last additional information and let's close shop. Let's deal with the last additional. So we are done with uh we are done with that additional information. So the last additional information, let's talk about it and let's close shop for tonight. So what is the last additional information? The examiner said, finally, the director has included what? Has included 10 million naira alone. They now include it in cash and cash equivalent. The loan has no specific date, repayment date. Then the director feels that there is no problem. Is that not a problem? There is a problem now. How can you do what? How can you account for loan? You go and add it in investment. That is wrong now. That is totally wrong. So how are we going to correct it? How are we going to correct it? So let's quickly correct it. Loan to director. So loan to director. How much is it? 10 million, Abi. We are going to correct. It's an error. They want us to correct error here. So let's copy this journal. Let's debit one thing and credit one thing. So where are we going to debit? We are going to recognize that loan. We recognize that loan. We call it loan receivable. Loan receivable. We call it loan receivable because they are going to collect that loan back. Loan receivable. Then we will credit what? We will credit cash and cash equivalent because they recognize that 10 million naira loan in cash and cash equivalent, which is wrong. They took the loan to cash and cash equivalent. So we credit cash and cash equivalent. So what are we going to do? How much is it? 10 million. We debit, we recognize loan receivable, then we credit cash and cash equivalent. And what's the adjustment? Just go to the adjustment here. Now, loan receivable is a current asset, Abi. Is a current asset. So that is why I said you should leave two lines. Just recognize loan receivable here. Loan receivable. How much is it? Additional information. What? Is it not additional information? 4? No, the last additional information. Additional information 6. Yes. Additional information 6. How much is it? 10 million naira. Then we now correct that error. We now remove the 10 million naira here. That's the general entry I passed. So if we remove 10 million naira here, we recognize 10 million naira here. So that is additional information 5. Additional information 5. Sorry for the correction. Additional information 5. So they said there was no impairment in goodwill. There was no impairment in goodwill. So there was no impairment in goodwill. And that is the reason why our goodwill, there was no impairment. So impairment in goodwill. There was no impairment in goodwill. Impairment in goodwill. New. So this one is not if. There is this one new. And we have even linked this to our SOFP. So we are done with the additional information. So the rest is to what? Is to balance our accounts. And I'm very sure our account will be balanced. I'm very, very sure. But this is where we are going to end our class tonight. I will just balance it up and I will send this Excel to you. I will balance it up. I'll send the Excel let's say tomorrow morning. So that is it. Question. Can I take question tonight? I don't think I can take question. Oh yeah, quickly type your question in the chat box. Let me see if I can take, or you can send it to my DM. I can look at it very early tomorrow before I start work at the office. But the time is gone. This is past 11. And I have not eaten. I have not even settled down. So that is it. This dog. So this is where we are going to end our class tonight. I'll balance this question so that you are not going to waste extra 20 minutes to be balancing question. So good night, everybody. If you have any question, please send it to my DM. I'll answer you. You are welcome. You are welcome. So good night, everybody. Let's take care of ourselves. Next week, we are going to